In today's video, I'll be going over one of the most important topics in trading. And no matter what strategy a lot of different traders use, this one concept is applicable and used in almost all strategies. In fact, it is what the market needs in general. Like not what the market wants, but what it needs for it to do its daily movements up and down. And the concept I'm talking about is liquidity. I'm pretty sure a lot of you have heard of it by now, know it, or maybe even understand it, which is very good. But then, if you don't really understand it, then this is the video for you. So today, I'll be going over liquidity, and I'll look at some of the, not some really, but I'll just tell you some, and then I'll go over one of its sources. So, right now, I know in your head, you may be thinking, what is liquidity? It's not a very difficult definition. Like, imagine liquidity is basically fuel the market needs to move up and down. So before the market goes up, it needs to get liquidity somewhere, and before it goes down, it needs to get liquidity somewhere, right? So basically, that's what liquidity is. And you may be thinking of, okay, so where does it come from? What generates liquidity? What generates this fuel? Basically, your stop losses, your buy orders, your sell orders, stuff like that. That's what generate liquidity. Those are the things that generates liquidity. So if there's an area with like 6 billion stop losses or like 6 billion buy orders, it's just an example. The market is most likely to go there because it either needs to take people out of trades or put people into trades, right? So that's how liquidity works. It's basically fuel the market needs. Don't overcomplicate it. I know some others can make it a bit of complicating, but don't worry, it really isn't a very complicated explanation. So, like I said, there are sources. Think of your car, right? You have a car. Whenever you want to go somewhere, you need fuel, right? If you want to go to town, if you want to go to see your mother, if you want to go do whatever, your car cannot run without fuel. And just like with the markets and fuel, there's specific places where you do find fuel. You don't just go like anywhere and there's fuel. There's specific places where you know fuel is found here. And so in the markets, we've got the exact same thing, right? In trading. In trading, there's specific areas where there tends to be a lot of liquidity because there's a lot of stop losses, buy orders, or sell orders within those areas, right? So I'll get into some of those sources. So one of the sources is called swing points, right? Or internal range. Internal range of liquidity. We've got fair value gaps, FVGs. Then we also have news candles. Sheesh. So we've got news candles. We have something called equal highs and lows. And then we've got what I like to call mountain tops. So because I don't want to confuse you, I'm not going to go into like every single thing because there's other stuff. There's something called what do you call it? There's something called yesterday's candles high, yesterday's candle low, and there's something called also session liquidity, like liquidity built up from different sessions within the market. But like I said, because I'm genuinely trying to not confuse you with too many topics, I'll just focus on a few of them today. So we've got swing points, also known as internal range, fair value gaps, news candles. I think you all know what news candles are by this rate. Like news candles, you should know what they are. Like those very big candles you see developing after news. We've got equal highs and equal lows. You need to understand candlesticks to understand equal highs and equal lows. Then you've got mountain tops, which that's my term. So, I just call it mountain tops so that it's easier for people to understand. But yeah, so like I said, I'm not going to get into detail all of them. I will make separate videos for each of them. But then today, I'm going to focus on the first one, which is swing points or internal range of liquidity, right? So let's get into it. So I know you may be wondering, what is internal range of liquidity? Very good question, but it's very simple. I know you people know you by now. You should know what an uptrend is and a downtrend is. So when you look at an uptrend and a downtrend, right, you've got those higher lows and those lower highs. So you've got higher lows, yes, higher lows. In an uptrend, in a downtrend, you have lower highs. So those two are internal range liquidity or swing points where the market swings, like that swing point thing. So let me just draw it so that you see what I'm talking about. So you see, here we have an uptrend, right? So this is an uptrend, right? This is a range. So this entire thing is a range, right? And so within this range, there's liquidity in specific areas, right? And when looking for liquidity in these specific areas, look at these points. So the higher lows I was talking about, these areas. So these areas is where you find liquidity in an uptrend. In a downtrend, you look at these points, the lower highs. So in an uptrend, liquidity is mainly found in the higher lows, and then you've got the lower highs over there, right? Those are the swing points. Those are the swing points I'm referring to. Now you may be asking yourself, okay, why do these points have liquidity? Let me explain, let me show you why. So the reason why these places have liquidity, right? It's very simple. Remember, like what I said, look, what generates liquidity is stop losses and buy orders. Remember that. So in an uptrend, right, this is how it works. You've got your uptrend. When the market does this, when it retraces, majority of traders in this situation, they are anticipating the market to continue pushing up. Right, especially guys who do trend following strategies. They are anticipating the market to continue pushing up, especially after this retracement. So this becomes liquidity because, first of all, a lot of traders are putting in buy orders here. A lot of buy orders are being put in this area. So people are busy pushing, are busy pressing buy, are busy pressing buy, are putting so many orders. And so liquidity is put there, it's over there, people put their buy orders in anticipation for the market to continue pushing to the upside like that. So that's the first example. Second example, let's say the market does this, then it does this. Some impatient traders in this situation, do you know what they're going to do? They're going to buy here. They're going to buy again in anticipation for the market to continue pushing to the upside. Where do they put their stop losses? Majority of them will put them here, or somewhere in between, but in this area. So this is where stop losses are put. So it's either people are putting entries here, buy orders, or they're putting stop losses there. And so the market is here, stop losses there, and they're anticipating the market to continue pushing to the upside. And so that's what creates internal range liquidity. That's what I was talking about. That's what creates the like what I was saying, the buy orders, stop losses, all that. The reason why that internal range has got that liquidity is because that's where a lot of traders tend to put in buy orders and stop losses. In a downtrend, it's the same thing. So market is trending to the downside. Again, in this situation right there, in this exact moment, traders are doing two things. They're either putting sell orders here, above, they're putting above the trend. So they're putting sell orders here in anticipation for the market to continue pushing down. And so that's what creates liquidity again. Those sell orders that traders are busy putting in, especially when everyone knows this market is going to continue selling. They wait for the retracement they wait for the retracement. So before the retracement happens, they are putting orders in that area in anticipation for the market to come, trigger them into the trade, then it continues going down, right? You may be wondering again, fine, where do they put their stop losses? Again, same thing, right? Market is going down like this, then it's like this. Again, very impatient traders who enter here, right? Or maybe they don't really enter there. Let's not use the word enter. Let's say it's here. So they put what? Maybe it's so. No, wait, actually, they didn't put enter. Set of traders, they might enter in this situation. Impatient traders enter there. At this exact moment they enter. They don't wait for the retracement. Where are they going to put their stop loss? Here. Majority of the time, they're going to put it there. That's where they're going to put it. Because a lot of traders, they think that, okay, since the market is trending downwards, since this area is a signal for a change of character, I'm going to put my stop loss there because highly likely the market will not go back there, will not go back up there. So that's where they put their stop losses. So you see, this is why these areas, the lower highs and the higher lows, generate liquidity. That's because that's where people tend to put either their sell orders, buy orders, stop losses. And the market is moving around, looking to trigger them, take liquidity, and go on about their day. Going about its day, sorry. So that's internal range and swing point liquidity. I hope you understood. I think it wasn't very too complicated, but I did try to explain to you why these areas are said to have liquidity, right? So I hope you guys understood. If you didn't, you let me know. But that's how it works. So it just let me know if you want to understand. This is a very first concept. Swing points. Well, not very first concept, but it's one of these sources. So if you don't understand, you let me know. But for now, that's swing points and internal range liquidity. So that's it for today. I'll come up with another video explaining something else. But as for now, that's it. Catch you in the next video.